Hey guys, David Johnston here. This is day 28 of crypto, DeFi, and PegNet talks that I've been giving. And today I want to talk about stablecoins because last week was pretty incredible for events in the stablecoin universe. We'll talk about the Financial Stability Board, Libra 2.0, and the China National Blockchain Committee. So this all sort of happened really quickly in about 72 hours last week. First, we had China announcing that they've got a national blockchain committee. Here are the 71 corporates and academics that are going to be involved in rolling out the blockchain strategy and really the whole tech stack in China for stablecoins and all the different use cases that the government is allowing there. Next, you had the Financial Stability Board, which is an entity that came out of the G20 and is now funded by the Bank for International Settlements. It's based in Basel, Switzerland, and they released these top 10 guidelines to effectively all the world's central banks on how to treat, quote, global stablecoins. And this came out of last year, the G20 asking the FSB to give these recommendations. What should it do about stablecoins, largely in reaction to Libra and the proposal that came out in 2019. And so not surprisingly, the next day after the SFB regulations were released, Libra released their Libra 2.0 white paper and basically described how they're going to comply with all these regulations and requirements that are coming from central banks and regulators and governments around the world. So let's kind of back up and unpack some of those developments. So first with the FSB. Their 10 recommendations are pretty stringent and effectively apply to any global stablecoin that is centralized in any way. If you're a reserve or an operator or involved in, sort of creating any sort of centralized stablecoin, these probably apply to you, a la Tether, USDC, Gemini, anybody with a centralized stablecoin. And to boil them down, it's really, okay, you need to be a regulated institution. You need to have, permission from regulators. You need to apply AML, KYC, all the sort of standards that have evolved for preventing bad actors, et cetera, et cetera. And so what this got translated into in the white paper that got updated by Libra 2.0, is 4 things that they're changing. One, they're going to give up on the decentralization. Originally, they had this 5-year path and they were going to figure out how to do permissionless validators. They're not going to do that anymore. Basically, the regulators told them you have to have known validators, as in the people running the blockchain need to be large financial institutions. So that's the direction they're going. The second thing is they're going to implement this financial intelligence function, very, sort of Orwellian sounding. And it's going to effectively do all of that AML, KYC, and other monitoring of transactions and people on the Libra blockchain. The other change that they're going to make is instead of giving users all the Libra basket, which is sort of a mix of these different national currencies and securities and these different assets, instead in the US, Eurozone, in Singapore, and in Great Britain, people are going to get their individual Libra dollars or Libra euros or Libra pounds or Libra Singapore pounds as the unit when they use the Libra system. If you're a user in any other country, you'll still get the basket until your country releases a central bank digital currency. And then Libra has indicated that they'll add more and more single country currencies as governments either request that, require that, or effectively release something that will be interoperable with their blockchain. And if a central bank digital currency is released by the Eurozone or for the dollar, then they'll replace the reserves that they're holding in the basket with those new central bank digital currencies. So sort of a big pivot for Libra. They've still got the words in there about banking the unbanked, but come on, everybody knows that's impossible. The reason a lot of people are unbanked is because they don't have a permanent address and they can't pass KYC. This happened to one of my relatives when he changed countries. He couldn't get banked for like a year because he needed XYZ documents and to establish residency for a certain time. So the idea that people are going to be able to push a button, create a Libra wallet, and access banking, and solve sort of this problem, it's not going to happen. So effectively, what's happening is there's a bifurcation going on in the industry. Either you're going to be a highly regulated extension of the central bank, like Libra and USDC and Gemini, or you've got to be totally decentralized. You need to be not an operator, have no reserve, have no collateral, have, et cetera, et cetera, et cetera. Like effectively just the user involved. And that's where it's going to get really interesting, because what does this mean for Tether? What does this mean for other stablecoins that might not be in a position to go fully regulated? Are they going to pivot towards a decentralized model? And of course, for PegNet, like they're already there. They're like the anti-Libra. There's no foundation, there's no reserve, there's no collateral. Literally, the user is in control of every function in the system. And so I think a lot of projects are going to have to follow that model. But this could move fairly quickly. The regulations are effectively under public comment until July 15th. And then presumably they'll take all those comments and generate a final set of reports and guidance. And then it's up to the member jurisdictions, the central banks in each country, to decide when they're going to implement those guidelines into regulations or law, and then start applying them to exchanges or stablecoin projects. So maybe it's a 6-month timeline, maybe 12 months. It looks like Libra is going to push towards getting to their mainnet and getting launched. It wasn't exactly specific in the new white paper, but it seems like they want to accelerate the efforts to get live. I'll be interested on the timing if they're able to get live with Libra before the regulatory pressure fully comes down on all the existing players, and how much that will move the market towards them. And whether players like USDC, which is owned by Coinbase and Circle and other companies, will go ahead and jump onto the Libra blockchain. Coinbase is already a member of the Libra Association, so it doesn't take a lot of imagination to think they may well join the blockchain, because that will give them known validators, and they may be able to transition USDC to the Libra blockchain or some other blockchain that has known validators. But it's hard to see under the regulations how they'd be able to keep USDC on Ethereum. Maybe somebody will create a private version of Ethereum where there are known validators, but not on the public network. So it's going to be really interesting to see as this sort of flows through the system. But the risk is that people act too slowly, and exchanges don't switch, and wallets don't switch, and the regulators come down at some point later this year or next year and really clamp down on existing players before they're ready to either go fully regulated or become fully decentralized. And that's, I think, the big systematic risk. I've been sort of looking for the last couple of years, what is the big systematic risk? This is now clearly that risk. It's not ICOs this time. It's not an exchange failing. It's the either collapse or a really messy unwind of one of these big major stable coins, most obviously Tether, but it could be really any of them if they stumble along this path of going fully centralized or fully decentralized. And it doesn't look like there's going to be much room in the middle. There's a couple of people still signaling that, but I don't know if that's based on them actually reading the guidelines. It's a fairly lengthy report from the Financial Stability Board, but if you read the guidelines, there's not a lot of room left for interpretation. And, it'll be interesting to see how it plays out. But, for DeFi folks, this is all the reason in the world that we need to continue pushing down the route of fully decentralized, because otherwise we're not going to really realize the dream of crypto, which is to enable all people to access honest money. And if the only people that can access it are the existing people that are banked, then we're going to be missing large parts of the global population because they can't qualify under that model. So anyway, highly interesting developments. When it comes to China, of course, they're not participating in the Libra Association. None of the major Chinese companies, to my knowledge, are members of the Libra Association. Maybe that's changed. I know they're recruiting new members, but it seems like China is firmly creating a different tech stack based on Hyperledger Fabric and versions of Ethereum. Depends on which company. They've all sort of got different blockchain initiatives, and they're weaving them together in China under this Chinese National Blockchain Committee. And it'll be interesting to see what happens. But clearly, they're moving in the same direction in the sense that they want all of those same type of regulations as were put forth by the Financial Stability Board. But rather than join something like Libra, which seems like it'll really dominate payments for stablecoins in Western countries, that China will have its own tech stack really built on its domestic technology companies. So really interesting. Within a few days, we got guidance about how every major economy in the world is going to treat stablecoins going forward, and how the major corporations of those economies are going to implement those regulations. Now, the part that's still left open is for the startups, for the dApps, for the blockchains, for the DeFi projects in this green field of the decentralized side. There's not a lot out there. There's a lot of people that use the term, but there's not a lot of groups that are fully decentralized yet, don't have collateral or reserve-based models. It was really with the birth of PegNet in August of last year that we even had the first consensus-based stablecoin network with proof of work. And so, there's a lot of work to do to move down that road. But the good news is the 800-pound gorillas are out of the way. Facebook's not going to be playing. Neither is Apple or Microsoft or Google or any of these behemoths. They effectively have been sidelined to the regulated side of the world. And what's really left open is this green pasture, this blue ocean of decentralized offerings where the user is fully in control. So I think that's actually a good thing. It leaves a lot of room for new projects and new initiatives to get built, but we got to go build them. We got to go build them fairly quickly. So if you're not involved in something like PegNet yet, I'd really encourage you to check it out. There's a ton of information in these videos on my Medium at ptrader.co. There are the trading tools at pegnetmarketcap.com. You can see all the assets in the network. But we got to get working because there are $9 billion in stablecoins, and there may be a major shakeup in where that market share is a year from now, 2 years from now. So this is the time to really build a system that is neutral and open source and consensus-based and really can handle that much volume. There's a ton of work that has to be done to build the systems and make them resilient enough to handle billions and trillions of dollars of value. So anyway, great, interesting developments, great discussion, and excited to see what questions you guys will have. So thanks for everybody that's been leaving comments. It's been a lot of fun doing these videos. Hard to believe we're almost a month in to doing these videos, and the quarantine. This has been a nice bright spot to do something other than the typical daily routine. So great talking with you guys. I'll see you tomorrow. Wear a mask. Be awesome to one another. And crypto on, my friends. Take care. Bye.